November 11th, 2022, 2:47 a.m. Eastern Time. A single tweet appears on the timeline of Sam Bankman-Fried, the 30-year-old billionaire who had become the face of cryptocurrency's future. FTX is fine. Assets are fine. 8 hours later, his empire would be worth zero. To understand how $16 billion vanished in less than a week, we need to go back. Not to the beginning of FTX, but to the moment when the mathematics of fraud became inevitable. Because what happened at FTX wasn't just a collapse. It was a mathematical certainty hiding in plain sight. Sam Bankman-Fried, known universally as SBF, wasn't supposed to be a cryptocurrency mogul. He was an MIT physics graduate who worked at Jane Street Capital, one of Wall Street's most prestigious quantitative trading firms. He understood probability, arbitrage, and most importantly, he understood how to exploit inefficiencies in financial markets. In 2017, he discovered something remarkable. Bitcoin was trading for $7,000 in the United States. In South Korea, due to capital controls and demand, that same Bitcoin was selling for nearly $9,000. A 28% difference. This is what traders call an arbitrage opportunity. Buying low in one market, selling high in another, and pocketing the difference. It's risk-free profit if you can execute it fast enough. SBF founded Alameda Research in 2017 with one purpose: to exploit these arbitrage opportunities in the chaotic early days of cryptocurrency. And it worked spectacularly. By some estimates, Alameda Research was making $25 million per day at its peak. SBF's personal wealth grew to over $1 billion in less than 3 years. But there was a problem. To move money between countries quickly enough to exploit these opportunities, you needed relationships with cryptocurrency exchanges. You needed priority access. You needed control. And so, in May 2019, Sam Bankman-Fried founded FTX. Here's where we need to talk about what should have been impossible. FTX was an exchange. In simple terms, an exchange is a marketplace. You don't own the assets being traded. You just facilitate the trades and charge a fee. It's like eBay. eBay doesn't own the baseball cards and vintage furniture being sold on its platform. It just connects buyers and sellers. This is crucial, because if an exchange operator starts trading against their own customers using privileged information, it's not just unethical. In traditional finance, it's explicitly illegal. It's called front-running, insider trading, and market manipulation. But cryptocurrency in 2019 existed in a regulatory gray zone, and SBF exploited that gray zone in a way that was mathematically destined to fail. Here's what happened behind the scenes. Alameda Research, SBF's trading firm, had a special account on FTX. This wasn't publicly disclosed. The code that created this account contained a single line that changed everything. On November 2nd, 2022, a reporter at CoinDesk published an article that would trigger the fastest financial collapse in history. The article revealed Alameda Research's balance sheet, and it showed what insiders had suspected but couldn't prove. Alameda's assets were propped up by billions of dollars worth of FTT tokens. The cryptocurrency community immediately understood the implications. If FTT's price dropped, Alameda would be insolvent. If Alameda was insolvent, FTX might not have customer funds. If FTX didn't have customer funds, anyone with money on the exchange needed to withdraw immediately. The person who understood this better than anyone was Changpeng Zhao, known as CZ, the CEO of Binance, FTX's largest competitor. Binance had been an early investor in FTX. They had received FTT tokens as part of their investment. And on November 6th, CZ announced on Twitter that Binance would be selling all of its FTT holdings, worth approximately $530 million. The message was clear: we don't believe FTT has real value. The market agreed. Within hours, FTT's price began a crash. It fell from $22 to $15, then to $10. And this triggered the death spiral. Remember the mathematics. Alameda's $5 billion in FTT tokens were now worth $3 billion. then 2 billion, then 1 billion. As FTT's price fell, Alameda's assets shrank. As Alameda's assets shrank, they couldn't meet margin calls on their loans. As they couldn't meet margin calls, lenders liquidated their positions, selling more FTT, pushing the price lower. But more importantly, FTX customers started to panic. On November 6th, customers attempted to withdraw $6 billion from FTX. In a normal, healthy exchange, this wouldn't be a problem. You'd have $6 billion in customer funds sitting in cold storage wallets, ready to be withdrawn. But FTX didn't have $6 billion in customer funds, because Alameda had borrowed it, and Alameda had lost it. By the morning of November 8th, FTX had paused all customer withdrawals. The official statement said they were experiencing technical difficulties. The truth was simpler. They didn't have the money. SBF spent the next 48 hours desperately trying to raise emergency funding. He reached out to every major cryptocurrency firm, every venture capital fund, anyone who might inject cash to keep FTX alive. On November 9th, CZ announced that Binance would acquire FTX, subject to due diligence. For a brief moment, it seemed like customers might be saved. But then Binance's legal and financial teams looked at FTX's books. What they found was worse than anyone had imagined. On November 10th, less than 24 hours after announcing the acquisition, Binance withdrew their offer. In their statement, they cited concerns about mishandled customer funds and alleged U.S. agency investigations. The translation was clear. FTX's hole was so deep that even Binance, the largest cryptocurrency exchange in the world, couldn't fill it. On November 11th, 2022, at 6:30 a.m. Eastern Time, FTX Trading Limited, Alameda Research, and over 100 affiliated companies filed for Chapter 11 bankruptcy. The filing listed more than 1 million creditors. The estimated shortfall was between $8 and $10 billion. $10 billion of customer money had simply disappeared. And Sam Bankman-Fried, the billionaire who had promised to give away his fortune to save the world, resigned as CEO. In the weeks following the bankruptcy, forensic accountants, lawyers, and investigators began piecing together what had actually happened inside FTX. What they discovered was a company that had no internal controls, no oversight, and no separation between customer funds and company operations. John Ray III, the new CEO brought in to manage FTX's bankruptcy, had overseen the liquidation of Enron, one of the largest corporate frauds in American history. In his first filing to the bankruptcy court, he wrote, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here. The evidence painted a picture of spectacular mismanagement and intentional fraud. Customer funds were used to purchase $300 million worth of real estate in the Bahamas. SBF and his inner circle lived in luxury penthouses at the Albany Resort, one of the most expensive properties in the Caribbean. They bought boats. They funded political campaigns. They invested in Silicon Valley startups that had nothing to do with cryptocurrency. But the most damning evidence was found in the code itself. Investigators found that the allow_negative parameter for Alameda Research wasn't a bug. It wasn't an oversight. It was an intentional feature hard-coded into FTX's system. Moreover, there were functions in the codebase that actively concealed Alameda's debt from internal accounting systems. When FTX generated internal reports about customer assets, Alameda's massive negative balance was excluded from the calculations. This means that even FTX employees who thought they were monitoring the company's financial health were looking at false data. The fraud was designed at the architectural level of the software itself. Even more incriminating were the internal messages between SBF and his co-conspirators. In Signal chats, which were set to auto-delete after 30 days, SBF and Caroline Ellison, the CEO of Alameda Research, discussed how to hide the truth from investors, regulators, and customers. In one message, Caroline wrote, "We've been like hilariously beyond any threshold of any auditor being able to even partially get through." In another, when discussing how to explain Alameda's loans from FTX, she wrote, we're not really being honest with the world. SBF responded, yeah, these weren't the messages of executives caught in an unfortunate situation. These were the messages of people who knew exactly what they were doing. But perhaps the most revealing evidence came from the mathematics itself. Let's return to the core question. Was the collapse of FTX inevitable from a mathematical standpoint? The answer is yes, and we can prove it. This is called a guaranteed insolvency trap, and it works like this. Condition 1. Circular collateral. When your asset's value depends on your ability to repay debts, and your ability to repay debts depends on that asset's value, you've created a positive feedback loop that can only go in one direction, down. In FTX's case, Alameda's ability to repay FTX depended on FTT maintaining its value. FTT's value depended on confidence in FTX. Confidence in FTX depended on Alameda's ability to repay its debts. The moment confidence broke, for any reason, the entire system was guaranteed to collapse. We can express this mathematically. Let V equals value of FTT, let C equals confidence in FTX, let it equals Alameda's ability to repay. We have V equals F, C equals G, A equals HV. This creates a recursive function where V equals F, G, HV. In stability analysis, this is called an unstable equilibrium. Any small perturbation, any loss of confidence, any negative news, any external shock causes the system to diverge catastrophically. It's not a question of probability. It's mathematical certainty. Condition 2. Negative sum game. For FTX to survive, it needed the following equation to be true. Customer deposits greater than or equal to customer withdrawal demands. But Alameda had borrowed customer deposits and invested them in liquid assets, real estate, startups, FTT tokens. This means liquid assets total customer deposits. In a fractional reserve system, this can work if withdrawal demands are predictable and spread out over time. But in cryptocurrency, where transfers are instant and customers can panic withdraw everything simultaneously, you need full reserves. FTX had fractional reserves, but they didn't tell anyone. The moment customers realized this, withdrawal demand spiked, and the inequality became liquid assets, withdrawal demands. At that point, insolvency isn't just likely, it's guaranteed. Condition 3. The impossibility of recovery. Even if SBF had found a white knight investor willing to inject $10 billion, the mathematics of recovery were impossible. Here's why. To restore confidence, FTX would need to prove they had on December 12, 2022, exactly 1 month after FTX declared bankruptcy, Sam Bankman-Fried was arrested at his apartment in the Bahamas. The arrest came at the request of U.S. prosecutors, who had filed criminal charges including wire fraud, securities fraud, and money laundering. In the indictment, prosecutors alleged that SBF had defrauded FTX customers of more than $8 billion. But the story was far from over. As investigators dug deeper, they uncovered a web of fraud that extended far beyond FTX and Alameda. They discovered that SBF had used customer funds to make over $300 million in political donations, making him one of the largest political donors in the 2022 election cycle. They found that he had bribed Chinese officials with $40 million to unfreeze Alameda's trading accounts. They learned that he had paid $250 million to acquire naming rights and sponsorships, using customer money to build a facade of legitimacy. But the most damaging testimony came from SBF's inner circle, who began cooperating with prosecutors. Caroline Ellison, who had been both the CEO of Alameda Research and SBF's on-and-off girlfriend, pleaded guilty to 7 counts of fraud. In her testimony, she admitted, "Sam directed me to commit these crimes. He was in control of Alameda's trading activities. He set up the systems that allowed Alameda to borrow money from FTX." Gary Wang, FTX's co-founder and chief technology officer, also pleaded guilty. He testified that he wrote the code that gave Alameda's special privileges on FTX, and that he did so at SBF's direction. Nishad Singh, FTX's director of engineering, pleaded guilty to conspiracy and fraud charges. He admitted to writing software that concealed the true size of Alameda's borrowing. The three people closest to SBF, the three people who understood exactly how the fraud worked, all testified against him. Their message was consistent. This wasn't mismanagement. This wasn't a company that grew too fast and lost control. This was deliberate, calculated fraud from the beginning. On October 3, 2023, Sam Bankman-Fried went on trial in the Southern District of New York. The prosecution's case was methodical and devastating. They showed the jury internal messages where SBF discussed hiding the truth from investors. They presented balance sheets that proved Alameda had borrowed billions in customer funds. They brought in witnesses, customers who had lost their life savings, investors who had been lied to, employees who had been pressured to participate in fraud. But the most compelling evidence was the mathematics itself. Expert witnesses walked the jury through the same calculations we've discussed. They showed how the system was designed to fail. They demonstrated that no series of good intentions or market conditions could have saved FTX once it had made its fundamental choice to use customer deposits as a personal piggy bank. The defense argued that SBF had simply made mistakes, that he was young, inexperienced, that he had been in over his head. But the prosecution's response was simple. You can't accidentally write code that gives your trading firm a special account with unlimited borrowing. You can't accidentally use $8 billion of customer money. You can't accidentally tell your employees to delete incriminating messages. These weren't mistakes. They were choices. On November 2nd, 2023, exactly 1 year and 1 day after the CoinDesk article that triggered FTX's collapse, the jury reached a verdict. Guilty on all 7 counts. Wire fraud, conspiracy to commit wire fraud, securities fraud, conspiracy to commit securities fraud, commodities fraud, conspiracy to commit commodities fraud, money laundering. The conviction carried a maximum sentence of 110 years in prison. On March 28, 2024, Judge Lewis Kaplan sentenced Sam Bankman-Fried to 25 years in federal prison. In his sentencing remarks, Judge Kaplan said, "There is absolutely no doubt that Mr. Bankman-Fried's name right now is pretty much mud around the world. He's already been sentenced to a lifetime of never being able to walk into a room where anyone knows him and not have people wonder what's in their pockets." But then the judge said, on October 3, 2023, Sam Bankman-Fried went on trial in the Southern District of New York. The prosecution's case was methodical and devastating. They showed the jury internal messages where SBF discussed hiding the truth from investors. They presented balance sheets that proved Alameda had borrowed billions in customer funds. They brought in witnesses, customers who had lost their life savings, investors who had been lied to, employees who had been pressured to participate in fraud. But the most compelling evidence was the mathematics itself. Expert witnesses walked the jury through the same calculations we've discussed. They showed how the system was designed to fail. They demonstrated that no series of good intentions or market conditions could have saved FTX once it had made its fundamental choice to use customer deposits as a personal piggy bank. The defense argued that SBF had simply made mistakes, that he was young, inexperienced, that he had been in over his head. But the prosecution's response was simple. You can't accidentally write code that gives your trading firm a special account with unlimited borrowing. You can't accidentally use $8 billion of customer money. You can't accidentally tell your employees to delete incriminating messages. These weren't mistakes. They were choices. On November 2nd, 2023, exactly 1 year and 1 day after the CoinDesk article that triggered FTX's collapse, the jury reached a verdict. Guilty on all 7 counts. Wire fraud, conspiracy to commit wire fraud, securities fraud, conspiracy to commit securities fraud, commodities fraud, conspiracy to commit commodities fraud, money laundering. The conviction carried a maximum sentence of 110 years in prison. On March 28, 2024, Judge Lewis Kaplan sentenced Sam Bankman-Fried to 25 years in federal prison. In his sentencing remarks, Judge Kaplan said, "There is absolutely no doubt that Mr. Bankman-Fried's name right now is pretty much mud around the world. He's already been sentenced to a lifetime of never being able to walk into a room where anyone knows him and not have people wonder what's in their pockets." But then the judge said something more significant. The defendant's apparent lack of remorse speaks volumes. He knew what he was doing was wrong. He knew it was criminal, and he regrets that he got caught. On October 3, 2023, Sam Bankman-Fried went on trial in the Southern District of New York. The prosecution's case was methodical and devastating. They showed the jury internal messages where SBF discussed hiding the truth from investors. They presented balance sheets that proved Alameda had borrowed billions in customer funds. They brought in witnesses, customers who had lost their life savings, investors who had been lied to, employees who had been pressured to participate in fraud. But the most compelling evidence was the mathematics itself. Expert witnesses walked the jury through the same calculations we've discussed. They showed how the system was designed to fail. They demonstrated that no series of good intentions or market conditions could have saved FTX once it had made its fundamental choice to use customer deposits as a personal piggy bank. The defense argued that SBF had simply made mistakes, that he was young, inexperienced, that he had been in over his head. But the prosecution's response was simple. You can't accidentally write code that gives your trading firm a special account with unlimited borrowing. You can't accidentally use $8 billion of customer money. You can't accidentally tell your employees to delete incriminating messages. These weren't mistakes. They were choices. On November 2, 2023, exactly 1 year and 1 day after the CoinDesk article that triggered FTX's collapse, the jury reached a verdict. Guilty on all 7 counts. Wire fraud, conspiracy to commit wire fraud, securities fraud, conspiracy to commit securities fraud, commodities fraud, conspiracy to commit commodities fraud, money laundering. The conviction carried a maximum sentence of 110 years in prison. On March 28, 2024, Judge Lewis Kaplan sentenced Sam Bankman-Fried to 25 years in federal prison. In his sentencing remarks, Judge Kaplan said, "There is absolutely no doubt that Mr. Bankman-Fried's name right now is pretty much mud around the world. He's already been sentenced to a lifetime of never being able to walk into a room where anyone knows him and not have people wonder what's in their pockets." But then the judge said something more significant. The defendant's apparent lack of remorse speaks volumes. He knew what he was doing was wrong. He knew it was criminal, and he regrets that he got caught. Today, nearly 2 years after FTX's collapse, the cryptocurrency industry is still dealing with the aftermath. Regulations have tightened. Exchanges now face pressure to provide proof of reserves, cryptographic verification that they hold the assets they claim to hold. The SEC and other regulatory agencies have become more aggressive in pursuing cryptocurrency fraud. And investors have become more skeptical, as they should be. But the deeper question remains, could it happen again? The honest answer is yes, because the fundamental dynamic that allowed FTX to happen hasn't changed. Cryptocurrency still operates in a regulatory gray zone. Exchanges still have enormous power over customer funds. And the technical complexity of blockchain systems makes it difficult for average users to verify claims. Moreover, the incentives are still misaligned. When an exchange controls billions of dollars in customer funds, and when there's no real-time auditing or oversight, the temptation to borrow that money for risky investments is enormous. Sam Bankman-Fried wasn't the first person to steal customer funds from a financial institution, and he won't be the last. But here's what we can do differently. We can demand transparency, real transparency, not marketing claims, but cryptographic proof and third-party audits. We can support regulation that protects consumers without stifling innovation. And we can remember that in finance, mathematics is truth. If the numbers don't add up, if the promises seem impossible, if the growth seems too good to be true. On November 11, 2022, when FTX collapsed, many people called it a black swan event, an unpredictable disaster that no one could have seen coming. But that's wrong. The collapse of FTX was not a black swan. It was a mathematical certainty that was visible from the beginning to anyone who looked at the structure of the company. When you allow your trading firm to borrow customer funds without limit, when you use those funds to prop up the value of your own token, when you hide the true size of the borrowing from customers, investors, and regulators, when you create circular dependencies where the solvency of one entity depends on the value of assets controlled by another entity, which depends on the solvency of the first entity, you haven't created a business. You've created a countdown timer to insolvency. The only question was how long it would take. Sam Bankman-Fried is now serving 25 years in federal prison. Caroline Ellison, Gary Wang, and Nishad Singh are awaiting sentencing, having cooperated with prosecutors. More than 1 million customers are still waiting to recover their funds that may never be fully returned. And the cryptocurrency industry is still grappling with the question of how to prevent the next FTX. But the mathematics have already given us the answer. You prevent the next FTX by understanding that certain structures are inherently unstable, that certain practices are guaranteed to fail, that you cannot build a sustainable financial system on lies, fraud, and circular logic. The mathematics of fraud are universal and eternal, and they always, eventually, collapse under their own weight. The FTX collapse wasn't just a failure of ethics or governance. It was a mathematical impossibility pretending to be a business. And mathematics always wins. As of December 2024, the story of FTX continues to evolve. Bankruptcy proceedings are ongoing. Recovered assets are being distributed to creditors. And investigators are still uncovering new details about the extent of the fraud. But perhaps the most significant development is this. The mathematics that destroyed FTX are now being used to prevent future collapses. Cryptographic proof-of-reserve systems are being developed that allow real-time verification of exchange holdings. Smart contracts are being written that prevent the kind of privileged accounts that Alameda had. And regulators around the world are implementing rules that require exchanges to maintain full reserves and undergo regular audits. The collapse of FTX destroyed billions in wealth and shattered trust in cryptocurrency, but also provided a clear example of what not to do, a case study in how fraud inevitably fails. And sometimes that's the most valuable lesson of all, because now we know the mathematics don't lie. And when we build systems that respect mathematical truth, systems with transparency, with verifiable proof, with genuine accountability, we create institutions that can actually be trusted. Sam Bankman-Fried tried to bend reality to his will. He tried to create value through manipulation and fraud. But reality, mathematical reality, bent back. And in the end, the mathematics won. As they always do. As they always will.